Hello and welcome to the Friday market update. Now, is there such a thing as a normal market anymore? Mortgage rates held steady this week at 6.5% for a prime borrower on a conventional loan, according to my go-to site, Mortgage News Daily, the most exciting website on the internet. It's a good sign. We've been trending in the right direction for weeks now, which is very, very good. Now, the inflation numbers came in this week as expected, and the jobs data is on deck next week. So we're going to be looking at that report as we always do. It's always a fun one. So hopefully it comes in, normal so that we can continue our trend down. But zooming out, agents often ask me this: where do you think rates are really headed long term? So here's my take. Now, this is based on 32 plus years in the mortgage industry, 7 years as a commercial real estate appraiser before that, and a lot of economic nerding out over coffee over the years. So what's normal anyway? And we haven't had a truly normal market in nearly 2 decades, not since the wild ride leading up to the Great Recession in 2008. Yep, that was 17 years ago. So let that sink in. That was a long time ago. Back then, mortgage rates were in the 6 to 6.5% range prior to the meltdown. Lending standards were, so let's call it loose. If you could fog a mirror, you could get a loan. Builders were just cranking out homes like it was a buffet line, and demand, whether from owners or investors, just gobbled it up and gobbled it up. They were just buying them up all over the place. But when the music stopped, we were left with an oversupply of homes and not enough qualified buyers. They just didn't qualify. The industry hit rock bottom. Lending standards tightened tremendously, and we entered into a decade-long hangover. That was a long hangover. It was like, oh my God, my head hurts. So for nearly 10 years, builders just couldn't justify putting up new homes. They were competing with the dirt cheap resales that were out there, and they couldn't build a home to compete with the resale homes. So to stimulate things, the Fed kept rates fairly low. From 2008 to early 2020, mortgage rates averaged around 4.3%. I mean, they went from 3.5 to 5, but on average around 4.3%. And then came COVID, and the Fed said, here, hold my beer. Rates crashed down to 2.5% range. Everyone refinanced or bought, and inflation took off like a Tesla in ludicrous mode. So the Fed hiked rates 11 times. They said, whoa, Nelly, slow down here. They hiked rates 11 times, and mortgage rates peaked at 7.82% back in October of 2023. So we've been trending down ever since. So where are we headed? So I believe the new norm, if you can call it that, for conventional rates will land somewhere in the 5% to 5.5% range. And so here's why. Here's my logic. So core inflation, which excludes food and energy, is currently sitting at 2.9%. That's the rate as of today that came out today. The Fed wants it at 2%, but let's face it, I really think we're going to be somewhere between 2.5% and 3%, which is going to be a pretty typical inflation rate over time. It's going to be hard to get down to that 2% level. The Fed funds rate is currently at 4.375%. What is the Fed funds rate? It is different than mortgage rates. It is the rate that the Fed sets to have banks charge each other on an overnight basis. So that's kind of a fixed rate, 4.375%. Historically, that's considered restrictive. When the Fed funds rate is higher than inflation, it is considered restrictive. So if 4.375, is that higher than the 2.9% core? Absolutely. So it appears that the Fed funds rate is currently restrictive. Mortgage rates now generally track the 10-year Treasury plus a spread of about 2.25%. So let's do the math on that. Today, the 10-year Treasury is at 4.21%. That's what an investor would get if they bought a 10-year Treasury. They get a guaranteed 4.21% for 10 years. So adding the spread, because mortgage rates carry a little bit more risk, adding a spread of 2.25% to that brings us right to the 6.47%, which is right in line with the 6.5% where we sit today. So I think if the Fed lowers rates over time, they will keep inflation trending down. That 10-year yield or the 10-year rate should consider to get closer to that inflation rate and get closer to 3%. So if it gets down to that 3% level, then we add the 2.25% spread, and voila, it's 5.25%. That's where mortgage rates should hit. That's the quote normal I see on the horizon. Now, since we really haven't had a normal market for 2 decades, what's the ideal market? So let's really stop chasing normal, because it's really hard to chase. I prefer to think of it in terms of an ideal. So an ideal market, in my opinion, is we see mortgage rates generally decline gradually. So they don't go steep, because if they go steep, values go steep this way. So more buyers can step in with confidence. Builders can ramp up supply to fill the gap. There's a big gaps in supply long term because population grew and we just didn't sell enough homes. We got a 3 million gap at least in regards to not having enough homes for the market. Move up buyers can eventually unlock their equity and stop feeling stuck. Because that rate's a little bit closer to some of the rates that they got back in the day, they can take the equity out of their house, move it into a new house, and actually probably have the same payment, if not lower. First-time home buyers finally can afford to enter the market. I want to see gradual increases in values, not the steep increase. So first-time home buyers, I think, will finally be able to afford to enter the market. So will we get there, and when will we get there? I think we will. My prediction is that we'll get there by the end of 2026, and that will be the sweet spot, in my opinion. Of course, I don't have a crystal ball, and nobody can really predict the market, but I've got a strong compass. I've got some wisdom. I've got a lot of scar tissue from the decades in this business. And one thing I know for sure, normal doesn't mean easy. It means stable, predictable, and healthy. And that's exactly what we're working on right now. I do believe that we're going to see this gradual decline in rates. I think that the market is ripe for people, for home buyers to jump in, get some of those seller concessions that the sellers are giving away right now. I don't think those are going to last forever. And if you wait too long, they will be gone, and you're just going to have to bring in more money for the home, more money for the closing costs, and it'll be a little bit more expensive. Your mortgage payment may be a little bit less, but everything else is going to cost you more. So I'd love to hear your prediction. So reply, let me know what you think, and if I'm out of my mind or if I'm dead on. This is Gaylord out. Have a great weekend. Bye-bye.